the 200 EMA underneath the pivot, and it's very, very rare I'll look for a trade where the 200 EMA is over the pivot, because that raises some conflicting factors, right? It could create some overlying resistance that I'm not taking into account of, and the one thing I don't like to do is trade underneath the moving average, especially when I'm looking to target a bullish outcome. Right? In order for us to assume the pivot in 200 EMA will provide us with a move that we're looking for, there needs to be this very, very clear discrepancy. Now, of course, a 200 EMA can be slightly underneath. It could be slightly underneath. It could be almost perfectly in unison, which is the more likely of a setup, but it can also be drifting somewhat below. Right? And this is not problematic. The only thing that changes is your associated risk with the idea and its potential slippage to the downside. But realistically, a setup usually always looks like this. You're usually given a deviation, right, below your 200 EMA, below your pivot. And the reason why we look for that, right, the reason why we look for that is because we need to determine an invalidation. Above all, when we're making a trade, we need to understand a potential risk or loss associated with the idea. Because if we just enter on the pivot without understanding where our low is, well, we leave ourselves to potential pitfalls. Potential trend reversals. And the last thing you want to do on an intraday strategy is take ideas that are likely to fail. You want to take ideas that are strong, have strong upside, but at the same time have a risk associated with the idea that either does not come out to a 50-50 outcome or severely suggests that the likeliness of this trade pays you off way more than your potential loss. So in an event like this, your pivots are quite tight, your invalidation is quite tight, but you have the exception of a price discovery market. So typically the way a trade looks, right? And we've been given some deviations, right, underneath, but there's context that provides you with the setup that you're being given. Each drop got shallower and shallower, lower and lower, tighter and tighter, until finally this level was finally flipped. Now, does everybody understand what I'm looking at? And I'll play it off so you guys can understand what we're looking at here. So right here, right, this slight deviation, these multiple deviations not only provide me with a shallow dip buy, and it gets more and more shallow as time goes along, as these two price points become tighter. My moment of impact, right, comes at this pivotal level, and there's no coincidence why it's called a pivotal level. It is where a significant move should be made on an intraday time frame. Now, there's going to be days where this doesn't happen, and there's going to be days where it does happen. But what's important is that you're given the signals more often than not to assume this move can be made. And what are the signals that I usually look for? Once again, I look for that deviation. I look for that sign of strength that could be noticed after attempting to break this bias, right? This mean/bias of the day. This drop, right, all the way down into 90,200 seems rather shallow, but in hindsight, right, with the trade that we took a couple days ago, it makes a lot of sense to assume this is my invalidation. It's rather tight, and these are my targets for the day. Now, why do I assume this, right? Well, first and foremost, we deviated underneath, we pushed back above the pivot, and when we came back to retest, the 200 EMA was held. So I have everything to assume that this gets tighter and tighter and tighter and flips a level of interest that I'm really looking forward to. And it's super, super crucial that you're given this sort of outlook, because if you take this trade too early, you pose yourself the risk of this pop that you're looking for, but the idea and potential of it falling through. Right? I'm sorry. If you're looking for this pivot 200 EMA move, right? Upon the first touch, without understanding its deviation, and then again, like, this is an exception market because you have your deviations underneath. So technically, this setup could have been taken here as well with a wider stop. But what you're looking for, most importantly, is the deviation underneath the pivot and the 200 EMA that is defended very heavily, and when it comes back to retest, shows you the signs that the level is becoming flipped. Now, I never usually limit in, right? There's going to be many opportunities. There's going to be many instances, right? And again, I'll look for examples so you guys don't just hear me talking for the sake of talking. There's going to be many examples where you see prices trading above the pivot, right? There's realistically no touch. I'll give you an example like this right here. Price trades above the pivot, But instead of limiting in just because it's touched the pivot or the 200 EMA, we need to understand where the potential downside is. We need to understand that the area is being defended. We need to understand that there's an area that it can deviate from. And so long as it doesn't go below that level, then the setup is valid. Right? And again, I have to look for live examples. We're not we're not in the market conditions over the past couple of days to assume, especially not today. Usually, I wake up every morning and I'm just given my levels, and I could just bid them accordingly. But today, it's pretty much an exception. The market kind of extrapolated into rather high levels overnight. So again, a lot of these levels were not respected due to a very, very large buyer coming in at the perfect moment. At least I like to think, and sometimes it's just trading. The nature of trading, volume can come in a sudden wave, in a sudden rush, and when it's not constant, a lot of the times your intraday strategies are not going to give you the triggers you're looking for. But in this case, you were given a number of reasons, to potentially take the idea, and there was some conflicting factors over here, which again do not support how I typically operate. But given the nature of Bitcoin's price discovery market, you kind of have to be a bit more aggressive. But just to put into perspective, right? A typical setup always looks like this, right? I have my pivot as my entry. I have my deviation below the 200 EMA as a potential invalidation zone. And then finally, the trigger is always given once I have clear signs, either a clear M15 close or a series of multiple closes. Sometimes I even look for multiple retests because I can assume that could happen before I assume the movement happens. But what's important is before a trade is taken, a stop loss always has to be determined. Okay? So sorry, I was just reading a question. So first and foremost, before any trade can be taken, we're not just taking it because, oh my God, look, my two lines come together. There's a number of reasons why you need to assume that, first and foremost, a level below that could suggest a trend flip or a loss of the trend needs to be established, it needs to be defended, and it needs to be pushed against strongly. So if I play this trade moreover, I just want you guys to see how it actually plays out in real time. I'm still waiting. All right. So everybody saw what just happened, right? Everybody saw what just happened in real time there. A strong push was located off the pivot plus 200 EMA. Now, why is that? Why would we assume that price would push to the upside? It's very, very simple. We defended a pivotal level on the intraday. Now, naturally, this is just a Fibonacci level, right? We had every reason to assume that our upside targets should be met in an environment that supports our bias. How do we know why our bias is supported? Because every deviation underneath our 200 EMA has been defended and reclaimed. The trigger for taking the trade here was the defending of the lows, a deviation underneath the 200 EMA, which quickly supported the pivot plus 200 EMA reclaim. Not only that, you're also given a retest that was sharply defended on a level that we very, very clearly needed to defend. Now, how did our stop get determined here? Well, I'm pretty sure you guys could see it right now, right? You guys could see just exactly why we had to stop, why we put our invalidation towards this area, and why we expected a move here. How do we know where to pull the fib? But that's the thing. Like I in the start of the stream, I literally gave you the automatic pivots that do it no matter what chart I look at. So these are going to be automatic for you guys. Every daily reset, it's going to set you with new levels and new pivots. So that's not like you don't have to do anything in that sense. I use an M15. I found the most success on an M15. I found less success with 30 minutes, 4-hour timeframes, and daily timeframes. Now, like any system, you could backtest it enough to find, confluence and reasons for taking a trade on those timeframes. But I found the most success on an M15. I find it's liquid enough. I find it provides enough volume per candle, and I think it's quick enough for a 24-hour daily candle period. It provides me enough time for movements to happen, and it provides me enough time in a day to consider my ideas. The big question is, what if we don't get a retest after the reclaim? A lot of the times it happens, then you're simply out of the trade. It is what it is. It's an intraday operation. It's either sometimes you get exactly what you're looking for, or you don't. And that, again, like I need to emphasize this about day trading. It's requiring you to put risk on the table, and if you're not getting everything you want, you don't risk. It's that simple. If the price moves without you, that's too fucking bad. Okay, I need you guys to understand this, that I don't put money up for the sake of putting money up. I put money up because I get everything I need to assume I'm making some, and still in those cases sometimes it does not work out. You have to. Yeah, no. I'm emphasizing for the whole class. I'm not attacking you. It needs to be emphasized that if there's no total incentive to take an idea, then there's absolutely no reason to risk any money. You wait for the setup. If it's given to you, you will know it's given to you. And if it's not, you have to be stoic in the way you approach markets. You can't play minds, you can't play tricks on yourself, because I'll tell you so many times when I backtest this system where, oh my God, it's just shy of the retest and it continues moving without me. I'll tell you so many times where that just came back, not only gave me the retest, but also lost the pivot, and now I'm completely fucked. And that's the one thing I don't want to do. I'm looking to compound on an intraday basis. So it's either the idea is there and it's for the taking, or it's not, and it continues to do something that is not anticipated by me. And for that reason, I am indifferent to it. I am indifferent to it. I just look for the next setup that will give me what I'm looking for. Right? It needs to be given on a silver platter. The risk needs to make sense with the potential reward. This covers in the risk management strategy, the risk management workshop in episode 1. I don't risk money on an intraday basis for the sake of risking it. I risk it because everything with my system, with my data, suggests that if I'm given this again, I have to take it, because not only do I have good risk to reward, but at the same time, I have every confluential factor to support this idea. And if I don't get that, I don't touch it. And you guys are going to have to be comfortable sometimes doing absolutely nothing. Because if you guys trade for the sake of trading, you're going to make mistakes, you're going to play catch up, and that's the last thing you want to do. It's about a compounding slow journey. Eventually, it comes into a point, guys, where one trade, right? I know with smaller accounts, you guys are probably looking at it as like, wow, if I don't take at least 10 to 15 trades a day, I'm never going to be trading for a living. It's a journey, guys. It's a process. It needs to compound over time so that when you do get your trades, that compounding difference is what makes the separating the money that you're looking for. In the beginning, you need to be comfortable with the idea that compounding is part of it. I know everybody wants to trade with 50K and make 2K a trade. I understand that. I understand it. I was in the same place. But if you're new here, if you're a beginner, you're going to understand that you cannot get there without it fitting your risk parameters, or else you're going to make mistakes, you're going to play catch up, and then you've lost control of the whole system. You're no longer following your data. You're doing things that you think work, not what your data tells you. So again, I need to emphasize that there's going to be times where you don't get the retest, and the trend is super aggressive. For example, like let's say you didn't operate on this trigger here. Well, now you're saying, well, if it goes to R1 and it comes back down and I get my flush, and don't worry, we'll get all into this later. I'm still teaching you the ropes. Well, then I should have just taken the trade anyways, because look what happens. I'm just letting it play out here, so don't think I disappeared. Do you guys see like why you need to wait for your absolute factor to play in? Because if not, you lose control of the idea. And again, it's so easy to look in hindsight and say, oh well, you know, it went up anyways. So even if I entered here, it would have been fine. Well, I want you to know how you're feeling the second it comes back down to chase you. Okay, it's a market, guys. So again, if you're not given exactly what you need, you stay out, because after that you've lost control of the overall idea. You've lost control of the original risk that's associated with the idea. Okay, but just to put into perspective, this will be recorded, guys, for everybody that's wondering. Again, so I let it play out a bit. By now, I'm going to talk about the exit strategies, but I need to just emphasize the triggers and reasons for taking a trade. So by now you guys understand. I look for a pivot plus 200 EMA just to cover up and recap. I look for a pivot and 200 EMA to hug underneath one or the other. Specifically, the 200 EMA hugs underneath the pivot. That's usually my sign that a mean/bias is being determined, and that mean/bias will most likely be defended if the trend is still intact. Okay. So we found our we located our invalidation. We could have even argued that, you know, the retest upon the first touch over here could have also been found with an invalidation there, but I found that to be rather wide for the potential targets I have. Right? So what makes sense for me naturally to take an idea that has relatively low risk with a fair off payout. And that's where we locate this deviation. That's where we trigger the trade upon this retest. We don't chase into it just because it went a bit higher over here. No. We need to see the retest. We need to see that once the deviation has been made, that the low has been established, ideally on our pivot and 200 EMA. That gives us support that the level's been flipped. And that gives us support that momentum to the upside should move. Now, I saw someone ask a question about the 200 EMA and how price gravitates towards it the most. I agree with you. That's kind of the whole reason why I consider it a mean/bias of the day. Now, why would I be interested in this idea knowing that we're trending in a certain way? Because prices tend to get irrational and they tend to move to these extremities, right? When a trend is lost and when a trend is won, prices love to gravitate to these inefficiencies. And once it's done tagging these inefficiencies, it most likely likes to come back to reality, which is where this 200 EMA is found. So why do I take a trade off this level? I take a trade off this level because I assume if the level is going to be defended, that once again, it'll go back to target this inefficiency. Does that make sense to the person that asked this question? I wouldn't call it a mean reversion. It's where I assume a healthy trend that I identified is most likely to respond from. If the most commonly traded price is going to be at this 200 EMA and we're in an aggressive trend or we're trending, then I assume this trend will push to the upside. And in many ways, it could always do this, guys. It could always do this. You could have your 200 EMA grinding up into your levels because ideally that's what we want. But the thing is, markets are inefficient like that. What they're going to do is they're going to pull and gravitate to where this inefficiency is met. So the whole point of this is that if a trend is being kept intact, right, even if it doesn't want to move away quickly, which it most likely should, and I'm going to give you a number of confluential factors for why I assume that happens, not just because I see two lines. There's a number of things that we're going to have to go over here, right? What we're expecting is that if this level is defended, right, and it's held and the deviations towards the downside are met as futile, what we're expecting is this 200 EMA to gravitate into said target points. So at the end of the day, we need to assume that this is being defended. If it's being defended, then we can most likely assume that these targets will be met, right? And there's going to be times where it won't be. You don't get what the 200 EMA actually is and means in the strategy. It is the mean/bias of the day. It's where we expect any sort of trend, any sort of price to be trading either above or below it to identify the trend that we're looking at. If it's below and it's showing weakness and it's showing that as a resistance, we assume, right, that the trend is looking to fall to the downside. If it's the vice versa of that, then we assume the trend is being defended and looking to resolve to the upside. It is the mean/bias of the day. It's where we expect most of the commonly traded average price to be. It's where we'll have the most density. It's where we'll have the most confliction point. It's where the max point of impact will be. I'm Abdul. I'm referring to a trade that we took a couple days ago, and I'm going over in a live example because again, today's pivots don't necessarily align with the lesson I'm trying to teach. So again, if the 200 EMA is understood now, if the reason why the trade is taken in this context is understood now, I'd like to move on to how the exits are found. And again, guys, like this will take some time for you guys to see the light. I'm doing my best to explain like how I look at things, but the thing is, after so many years of doing something, you forget to provide certain context to why you do what you do. So if anything comes as unclear, do not be shy to ask. I will emphasize why the importance of it is and why it matters so much. Struggle to find a QEMA search you use. I think someone else found it. Again, I remember it being shared to me years ago. It's quantified or it's quadrupled. It's slightly different. It's a slight discrepancy, but a 200 EMA will work just as fine in this environment. So guys, the thing about an M15 strategy, right, is that in a perfect world, we get exactly what we want, right? And this is what I'll show you. So, in a perfect world, we get what we want, right? This is one of those perfect world type of scenarios. We got exactly what we were looking for. A perfect R3 tap, maybe slightly below. If I remember correctly, 2 days ago, just to cut it short, I decided to take my final profit here, slightly below my 94,150. Yeah, I just felt I felt like we overextended for the day, and I was comfortable walking away just slightly below it. I felt like we got the point across. So I did close exceptional, just slightly below the R3, just because I felt like we really overextended. There was a number of reasons to assume that. In a perfect world, your pivot plus M15 combo will work like this. You'll get your deviation underneath. You'll get your pop up above the pivot plus 200 EMA. You'll come back down to retest the pivot plus 200 EMA without seeing a lower low in this sense, and then your trigger is taken. Your trigger is taken. You're in the trade at 90,890, 90,850, depending what exchange you're on, and the trade is off to the races. Naturally, how in the world do I expect to hit the R3 level every time? I can't, right? Because I am just expecting, when I'm given what I need in this environment right here, I'm expecting price to move away from the 200 EMA. It's tried to deviate below it. It realizes it's not enough. It tries to come back down to retest and dive deeper. It realizes that the pivot 200 EMA is strong enough. So naturally, what happens here? Not only do the confidence of buyers return, but now I'm also expecting an inefficiency in price to be mispriced here. I'm expecting an inefficiency. Now, where are my inefficiencies? I'm going to see them at this R1 level, this R2 level, this R3 level. Now, naturally, I'm not going to close a trade 100% for a measly baby move like this. No. I don't think the risk and the reward, right? The risk and the reward is worth it just to target a move like that. Naturally, I'm always looking for these three levels here. Now, how do I make sure I not only pay myself the whole way through, but at the same time, don't throw all my position on one idea? There's a number of ways to do this, right? And depending on the strength of your setup, depending on the context you provide or your expectations, I like to keep it simple all the time. There's not going to be every day, right? There's not going to be every day where I get my R3 levels. This is usually the optimistic one. It's in a daily time frame, if the trend is not strong enough, if the volume's not there, you're going to struggle to get this level quite a bit. So naturally, I can't put 100% take profit at R3. In a perfect world, like an example like this, it's like, oh my God, well, why would I take profit here and why would I take profit there if I know I'm getting R3? The truth is, you don't know that. You're going to have to see it as it goes along. That's the whole point of an intraday strategy. This is not something you enter right? Go to work for 8 hours and come back and wonder what happened to your trade. No, it's not like that. This is a completely high attention strategy that requires lots of eyes on it, periodic checking. You cannot, this is an intraday strategy. So I assume if you're doing this, it's because you are at charts all day long, right? I use it on all coins. If I'm given a trend, I trade it. Okay. But back to the point, I look for 3 take profits every day because, again, the goal on an intraday strategy is to compound and extract moves that you could spot. It's not about catching the Hollywood trade. It's not about catching the highest P&L. It's not about catching the biggest percentage move. We have spot strategies. We have swing strategies for this. We locate larger moves on larger time frames. We have different portfolios for this type of stuff. But for an intraday perspective, how can I extract from the market? And that's what this strategy is meant to focus on. So, knowing what I know, I entered the pivot plus 200 EMA. My entry is about 90,890. My first area to manage the trade is going to be at this R1 level. And again, guys, you will see times where you do get the move. You do get the move you're looking for, but it's not enough. And it actually just comes back and stops you out. This is trading. You took a risk, you took a setup, it lined up with your factors, but things and dynamics change over an intraday strategy. There's going to be times where you get stopped out. And I will provide you examples of what it's like to get stopped out. It's just part of the game. What's important is that your risk, right, heavily incentivizes the reward. Yeah, it's almost like I have to take this because if I don't, well, I potentially leave money on the table, and my my tolerance and my setups and my confluences are there, so I have to take it. Right? I'm given everything I need, so naturally I need to take it. Right? There's going to be times where your trade gets stopped out. It's only normal. It's trading. There's going to be a lot of things that will come into effect. But in a world where my trade does work out, right? Which will happen as well. What is my best way to extract from this entire price chart, knowing that I can't possibly determine if R3 will be hit today, knowing that I can't possibly determine if R2 will be as far as we go, and knowing that I can't possibly determine if R1 is all we go, right? I'm assuming that price moves off the pivot plus 200 EMA. That's my original thesis. That's my original conviction for taking the trade. Naturally, I expect a rather strong move, but sometimes you'll be met with areas that do not support that anymore. Sometimes buyers get exhausted, they run out of momentum, and they're not willing to capitalize on that. So how do I, once again, always look to extract and protect myself from the market once a market moves in my favor? Well, it's very simple. I look to take profit as it reaches my targets. Now, what levels am I looking at? Naturally, R1, R2, R3. So when you see me in my corner talk about this a lot, what am I referring to? I'm referring to my take profits. R1, R2, R3 off the pivot, right? So my pivot's my entry. R1 is my first take profit. R2 is my second take profit. R3 is my third and final take profit. Now, would anybody be able to understand what type of split I do here if I'm looking to exit a full position in 3 positions? If my size is 100%, beautiful. That's wonderful. Beautiful. 33%. I look to exit 1/3 of my trade at every one of these levels. Now, why do I do that? There's a reason for it. It's because I don't want the moment where money was left on the table to pass me by. If I'm given the move I'm looking for, my goal and priority is to extract from the market. Right? That's my priority. My priority is to extract from the market. Now, how do I do that? Knowing I can't possibly determine the full take profits, I need to pay myself as I go along the way. So it's essential because the whole idea of this portfolio is about growing it over a series of trades in time, right? And you cannot afford to give back money once it's done what you need it to do. At the same time, you don't have a magic crystal ball. Things change, volume changes, headlines come up, sellers appear, momentum can change in an instant. So, when keeping that in mind, the take profit strategy is one of the most crucial parts about this entire strategy. You cannot possibly expect to succeed if you do not follow this very, very strict risk profit taking strategy. I have 33% on R1, which means not only did the trade move in my favor, I'm also I'm also locking in money off that move. It's an absolute must. Money is being locked in on this move. There's been no waste in the potential that it comes back into my entry level. I'm not wasting any time. It's a move was made. My first level of interest was hit. I'm taking money out of that. I'm closing a bit of my position, 33% to be exact. Now, in a perfect world, I also get R2. Well, guess what I'm doing there as well? I'm taking another 33%. So now I'm closing 2/3 of my position. Because now I assume I'm in, okay, I got the move I'm looking for. I extracted already once. I got an even higher push, right? And by now, your volume oscillator can be starting to get extended. So naturally, there's no telling if that final push actually happens. So what do? I lock in 2/3 of my position. Again, I put up a certain amount of risk here. If I'm not going to pay myself after I get 2 out of the 3 areas of interest, then I'm just round tripping and I'm gambling. I'm not making any progress. So what do I like? It's super important that I take money out when my levels of interest come in. Not only does this build discipline for the next trade, it's also compounding my size so that in the event, right, that the trade doesn't go its full R3 level, money has been secured, money's been paid. Now it's important to note this. You could pay yourself 66% of the position, but naturally, would it make sense that you pay yourself 66% of the position here, but you also leave the original allocated loss that you were comfortable with the idea? Does that make sense? Does it make sense to keep my original risk on the table if I have the potential of it coming all the way back down to touch me? Naturally, I don't want that to happen at this point. And if it does, I need to protect myself. So what would I do? Beautiful. Right then and there, the move has been made. My idea is correct. But being correct doesn't allow me to be stubborn. It doesn't allow me to round trip my gains. It doesn't allow me, to play with the risk. I already put up money on the idea that it would move. So now that that's happened, it's hit 2 out of the 3 of my expectations. This thing right here gets eliminated. I'm at a break even position. And again, this is a position of strength here because not only did you pay yourself 33% here, 33% here of your total position, not only is that money locked in, there's officially no more money on the table for someone to take from you. The move has been made. The idea was right. Does it get the full perfect Cinderella story? Nobody knows. In many cases, sometimes it will, but in a lot of cases, it won't. So I need to protect that at all costs. There's no need for me to put more money on the table, knowing it already did 66% of my expectation. So now that last 33%, we usually run it till the end of the daily close. And depending on where it's closing at that time, we either close the price, we close the trade, the remainder of the trade for the price it currently trades at, or we wait for the final take profit. And that is how you walk it up, eliminate your risk, and continue to compound your portfolio daily. You hit your first take profit, you pay yourself, you confirm payment of the trade, meaning your idea worked in your favor. It did exactly what you needed it to do, right? So once it does what it needs to do, once money's locked in and secured, not only do you help yourself pay the fees for executing the trade itself, you also remove the risk that is associated with the idea because it makes realistically no sense to pay yourself 33% and then allow yourself to get stopped out. You're going to be break even, right? So you eliminate the risk. At the very least, you want to be able to walk away with something. Your move didn't go in vain. Your setup didn't go in vain. And that's the whole reason why you're doing it this way. So I hope that part made sense. And again, this episode is teaching you the basic fundamentals of how it's engineered, how it runs in a single day. And after this, I promise you will come the discrepancies, the confluential factors, the things you look at to support the idea, right? This is just the naked eye technical setup. This is exactly what I look for on a day-to-day basis. Now, there's going to be discrepancies. There's going to be context that you need to take. And the more context you have, the more likely you are to find a winning setup. This will be covered in the second episode, okay? But today was just about teaching you why I do what I do, when I talk about R1, R2, R3, and how I look at it, why I take that, how I locate the stop, how I determine if a setup is strong or not. There's going to be things that need to be covered in over a series of episodes. It's not so simple, right? It's simple, but it's not so simple. There are small little discrepancies that I'm going to need to teach you along the way. But what needed to matter today was the direction of a trade, why I assume the direction of the trade is happening, and how I choose to go about it. How many trades should be taken at once? That's up to your discretion and your risk tolerance. There are many, many days where I'll have a trade, I'll have 6, 7 setups across the board. I assume as long as they align with each other, and not align with each other because they're completely out of context to one another, but assuming all my technical indicators and every reason I have for taking a trade on any given day all line up on every pairing that I'm looking at, then it really doesn't matter how many trades you take, right? Now, I'm someone that doesn't like to overmanage. I like to take maybe 2, 3 trades at a time. I don't like to be exposed to 7 or 10. It gets kind of stressful. It's a lot to look at. And, I like to stick to the things I like the most, right? But it doesn't stop you from taking multiple trades at once. That just comes down to a risk management. That just comes down to a risk factor and what you're willing to risk. Ideally, the thing needs to make sense for the reason why you're taking a trade. Again, you don't just take it because it's there. You take it because there's reason to believe that money on the table at this moment in time highly favors me. And in the event that it doesn't, well, the loss is not substantial enough for me to feel like it wasn't worth it in the first place. It's like a poker hand, right? You get a different hand in poker every round. Sometimes the incentive is there to go big, to take it. Sometimes you fold. It's the same thing. It's the same thing. It's a risk management. Yeah, I trade and again, these are going to be a little context to why I trade a certain pairing, why I assume it can move, why I assume it's trending. And again, there's so many things we'll need to cover. That this is just the basic raw understanding of the naked visuals I post in my corner every day. But there's going to be a number of things: volume turnover, 24-hour volume, open interest, funding rates, reasons to assume why a push can happen in the direction that you do it. Right? I just gave you one example out of hundreds I take every month. May I ask you personally, how much percentage is in a risk of a trade like this? I like, when I'm scalping, I don't like to risk. And again, sometimes my sizes are a bit bigger than yours. So again, I like to keep on an overall portfolio. When I am scalping, I look for anywhere between 0.5 to 1.5, max 2%. Right? It's about compounding. It's about keeping your win and loss in a ratio that winners outperform the losses. Even if you were to lose 6 trades in a row, those winners, right? Those 4 wins need to overcome your losses. So again, it's not going to be about win rate, this one. It's going to be about the potential profit and extracting from it, right? It's going to be less about win rates. It's going to be more about the fact that, because for me, a winning trade is one that hits all its R3s. Okay. And in many, many cases, it's probably going to hit R2, R1. But it doesn't matter, because the money is still in a positive impact. Now I know some people would say, well, isn't that a winning trade? According to my journal, that's actually, something that went south. But at the end of the day, the profit overweighs the risk, and that's super, super important. Let's find a setup today, can we? I mean, do you really see a potential setup here with 10% across the board? I think a lot of the market's offside here and got caught. Bonka lines. Okay, let's take a look. Let's try and do one live example before we get off. Why not? Let me just exit this. Actually, it fucking does. That's crazy. Okay, so I'll tell you what I don't like about trading bonk, first and foremost. But I'll tell you what I do like. So once again, we're actually witnessing a live example here of a potential pivot plus 2 GDMA setup. So this actually makes it much easier for me to provide context to what I need to look for from here on, okay? And again, if I don't have what I have, then I can't take the idea. So warning number 1, on a volume pairing like this, volume oscillators could come into big importance, okay? First and foremost, it's up 7% on the day. The whole market kind of went into a frenzy from this point on. But one thing I am looking at is the fact that, hey, my 200 EMA, my pivot are doing exactly what I needed to do. Confluential factor number one. My pivot and 200 EMA are aligned. Does this mean I could take the trade right now, guys? I'm curious. Do you think I could take the trade right here? In my opinion, right, based on my system, the answer is actually no, right? Now, I know a lot of people are saying, well, what do you mean? You have a deviation under here, you're retesting the pivot here. Why not trigger the trade here? There's something conflicting with this right now, okay? That I don't like. And this is volume oscillator. I don't like how it's extending into the positives. What makes more sense for me to assume here, right? And I'll tell you why I think it's better. And again, sometimes you're going to have to wait for a couple of retests. You're going to have to see something like this. And then the trade is taken. You guys have seen this in my corner, right? You'll see me squiggle something like this because I'm looking for the moment of impact, right? Now, why am I doing that? First and foremost, I think this is kind of extended. But what I can support is that any sort of flush met with a retest on this line, the more likely we are to trend into negative territory, the more likely I am to assume that the push to the upside and sellers being offside and an area that is being heavily defended with a mean slash bias of the day that suggests a push to the upside. That is why I'll take it. Now, and again, I know people are looking at this, right? And saying, well, isn't this my invalidation? Technically, yeah, you could be early to the idea. I'm not going to argue with you. The problem is on my strategy based on a number of things, I've seen this come down to retest a lot. So what would I rather look for here? I'd rather look for the tighter moment of impact. And a lot of the times when I see an oscillator like this, I'm almost expecting something like this to look like this. And then we have our moment of impact. So while this is trending to the downside, not only is this low being held, so in many ways you're taking the setup here might be right. But I think you have a better confirmation here. I think the confirmation is not only does it give me a tighter stop, right? I have less of a risk tolerance. I could probably put more of a higher risk on the table. It also just gives me that extra added confluence. My oscillator resets. That means the sell pressure has been absorbed. The mean slash bias has been defended, closed above, and it's most likely go time. Instead of sitting around, sitting in a trade for the majority of the time beneath your level, it makes more sense to try and execute on the moment of impact. This is what this sort of strategy focuses on. It's not to overstay your welcome. It's not to manage a trade underwater. It's we flipped our level. It's looking strong. It's looking hot. I have everything I need. Why doesn't this go up? Do you guys understand that? But this is a beautiful example. I want to thank someone for bringing it up. This is like a real life example of what I'd be looking for on an intraday strategy. And again, maybe this is exaggerated. What I really want to see is this. Something like this, pop back above, and then I think it does something like that, and then it goes. Problem is, this oscillator is heightening at an area I need to be defended. And if sellers have momentum here, it's very, very easily that they could push this back down. Do you guys understand? And again, if you guys are confused about the volume oscillator, we will cover this next episode because it comes into big handy. And again, not every trade is going to do exactly what I want it to do. But what's important is that I look exactly for what I need, right? Does price send from here? It could absolutely do that. Am I going to cry about it and whine about it? I'm way past that stage. It's nothing personal. A market being a market. Sometimes you get your setup. Sometimes you don't. You want to know what else exists? All these things. There will be something that will do what I want it to do. And that's where I focus on. So if I go look at Floki, let's go look at a couple more examples before I have to get off. I'm pretty sure there's another stream now though, guys. So I just want to be careful here. No, we got 30 minutes. We got 30 minutes. But also, I don't want to keep everybody waiting. We're having a pretty rolling day. I'll take a look at Floki. Ah, yes. Okay. Hmm. When did this open? Okay. That's interesting. So once again, you're given another. So, as you guys can see by now, we're looking for what we're looking for, right? Everybody understands what my eyes are on right now? That's the thing. It already touched R2, so we're going to provide some context to this. I'm just curious about something. Hold on. Okay. Yeah, we have a lot more to cover than I thought we would. There's a lot of things that I go, oh shit, it's true. I need to tell them about this. So that's very important. So, how do I go about this one? What would be my game plan for something like this? Knowing my oscillator is bottoming out every time it's had a response into these negatives, as you guys can see, absorbs into the 200 DMA, tends to have a strong response. What I don't like, how would I go about this? So, how would I go about this? Do I consider this an invalidation? Because if that's the invalidation, then the likeliness of this coming back. What's been our typical responses? The problem is if this is my invalidation, then that means this entry. Even though this aligns, I see things I don't like. Maybe that's just me. What's the volume turnover here? 400 mil on what type of market cap? Why is there no market cap here? Gonna do something like this. Feel like it does something like this. This makes more sense. So as much as a setup like this aligns with what we really look for, I don't know if it's something I'd trade. Can we apply it in reverse for shorts? EMA above pivot, oscillator bought, overbought everything? Yes, you can, but I found a lot of difficulty with the slippage. So a lot of the times, shorts that I would typically have tend to get runned or hunted very, very quickly. But yes, you can absolutely apply vice versa. Because once again, you are just looking for a moment of impact off the mean slash bias. And we assume that if it's being defended, well, then to the upside we go. And if it's being rejected, then to the downside we go. The only discrepancy I have with a short setup is that the slippage a lot of the times outweighs my potential risk. Or outweighs my potential profits for the number of risk I'd be willing or needing to take. But in this sense, guys, I see a lot of things I do like. The one thing is I don't like the volume. I don't like the volume. I find it rather low. But I'm also on Bybit, so that can provide a lot of context. But realistically, from a technical standpoint, it's doing everything I needed to do. I mean, you have a deviation beneath. It was held, it consolidated, it popped above the pivot. It's coming back down to retest. Realistically, this would be reset. I mean, the momentum would have to be to the upside. The momentum would have to be to the buyers here. This fits more of a setup that I'm more usually used to taking, believe it or not. Now, would I trade this one? I'm not sure. I'm not sure. These meme coins, they tend to slip really hard. They're less liquid, but on a technical basis, like you have everything you need, believe it or not. I'll be completely honest with you. So if I got it right, I would wait for a new sell, find my new invalid point, and after that, if the oscillators are set and that you may reclaim, take it with TP and R1 and R2. Yeah, literally what we covered. You find an invalidation, which I believe to be here. I don't see how you get your intraday momentum if this is lost. You're given your mean slash buys of the day. It's getting tighter and tighter. It's the moment of impact. Sellers get exhausted, but buyers seem rather weak. That's barely a move from bottom to top. I mean, technically, that's a setup. From a technical standpoint, that's a setup. All context aside, do I mind setting my? Yeah. But yeah, I think if there's going to be no more questions here, I think we'll end this class off today. Tomorrow, or not tomorrow. I think we'll have our next one Monday. Yeah, we'll have our next class Monday. And this time I'm going to be covering the volume oscillator and how it plays into effect with the pivot plus 200 EMA. This is the Okotoki setup, by the way. I had to get it changed. They updated it, so it's way more in tune now. Look at this wall. Oh my goodness. Yeah, next class I think we're going to cover more the indicators themselves rather than just the raw fundamental understanding of the setup. I think we'll do that, and I think we'll also introduce the S3 level. Yeah, the next class we're also going to introduce the S3 mean reversion, because of course I don't only just take the pivot plus 200 EMA, right? Like that's one setup that I look for commonly. There's going to be days where the pivot plus 200 EMA is completely lost. So there are usually ideas on the R3 level and the S3 level. So there's going to be a ton of things that we're going to have to cover. But what's important is that I'm providing all the context and nuance to every situation, which is actually much harder than I thought. I don't realize how many things I just autopilot. So a lot of the times, like, you guys will ask me something and I'll be like, holy shit, I never thought about explaining that, because it's just simultaneous in my head, right? It's something I'm so used to now. I forget that there's all these little discrepancies that I look at. So when you guys point me with a setup, I go, yeah, but there's this and there's that. And I go, oh shit, it's true. I didn't teach that part. So this not only helps me find a better lesson plan, but next week I'm gonna have I think our next class is Monday, right? Usually Monday at 9 o'clock. Yeah, I'm gonna have more of a structured thing. I thought I'd be able to wing this one. It's actually much more difficult than I thought. Guys, with that being said, we're about 20 minutes till New York Open. So again, I want to focus on the day. We have a big one ahead of us. I think we had one hell of a Asia session last night. I don't know if you guys were sleeping or not, but that was insane. I'm fucking tired as well, so please bear with me. But yeah, guys, I want to thank you guys so much for participating, bearing with me with my sleepiness and my lack of organization for this one. Usually, I thought it would be much easier to get everything in check. But at the very least, I hope you guys learned something. And if I didn't make something clear, please, if you're too shy, send me a message. I'll do my best to answer it in due time. You guys seem very, very attentive. There's not many times I had to explain something. You guys seem to really understand the way I'm talking to you guys. But next class we're going to do even better. We're going to provide live examples, even a PowerPoint if I have to, so you guys have some sort of checklist, some sort of guideline, so you know exactly what we're looking for. And that way, as the class goes along, you might even be able to share me some of your own setups, and we could take a look at them together. Guys, enjoy your trade day. Again, don't lose your head. Stay patient, stay calm, and trade away. Thank you for joining the class, and I'll see you on Monday.